So we're continuing to look at the issuance of bonds. Just a recap of what we went over yesterday. When we issue bonds, sometimes we issue them where the interest rate that's on the bond, so the face rate of interest or the contract rate of interest, both of those terms are synonymous, meaning they mean the same thing. That doesn't change, but the market rate of interest does change. It fluctuates because it's based on a market. People are constantly bidding what they're willing to loan money for. So as the market rate of interest fluctuates up, then the price of bonds drops. So sometimes we issue bonds when the face rate on the bond is the same as the market rate, which means we're issuing them at par, meaning we're issuing them at their full price. So if we issue $1 million in bonds, we're going to get $1 million in cash for them. Okay. Sometimes when interest rates go up, then the price of bonds drops and we issue them at a discount, meaning we're going to get less cash than the face value of the bonds when we issue the bonds. Other times, what we're going to look at right here, when market interest rates drop, it's going to push the price of bonds up. And the reason it does that is because if market interest rates drop, so we've got a bond with a face or contract rate of 6%, and the market interest rates drop to 5%, people who are lending money and trying to earn interest on it, that 6% looks a lot more attractive to them than the 5%. So they're willing to pay a premium. They're willing to pay a little extra for those bonds to get them. If you can't remember why market interest rate fluctuations affect bond prices, at least remember that it affects it in an opposite way. Market interest rate drops, prices go up on bonds. Market interest rates go up, prices drops on bonds. Like, at least remember the what, and then try in time to understand the why. All right, so let's look at what happens when bonds are issued at a premium, meaning they're issued for more than their face value. So this is Northern Idaho Transportation, Inc. issued the following bonds. Face amount, $100,000. Contract rate, or the bond rate of interest is 12%. Interest is paid semi-annually on June 30th and December 31st. The term of the bonds is 5 years, and the market rate of interest is 11%. So we can see these bonds are paying better than the market. So because the contract rate of interest is more than the market rate, the bonds will sell for more than their face amount. So these bonds are going to sell for $103,769 for $100,000 worth of bonds. So again, we always put how much we're going to get for the bonds in the cash. Cash goes up by that amount. And then bonds payable again means how much we're going to have to pay back at the end of the bond's life. So this is a 5-year bond. And then the difference is the premium. So really, with all of these bond entries, if you'll put the amount of cash you get as a debit and then the amount of bonds payable, meaning the amount you're going to have to pay back at maturity as a credit, then the difference to make that all balance will either be a debit, which would be a discount on bonds payable, or a credit, which will be a premium on bonds payable. So again, when you're in doubt, start with what you know. We know it's a $100,000 bond, so we're going to credit the bonds payable for $100,000, and you know that how much cash you're getting. This one tells us it's $103,679, and then just work out the difference. And I have to put it on. So in this case, we'll have to put it over here on the credit side to make it all balance, and that's going to be a premium on bonds payable. So let's look at an example of it. This will be question number 1 from the part 2 of the guided assignment. So this says, on the first day of the fiscal year, the company issues $5 million, 7%, 5-year bond that pays semi-annual interest of $175,000. They got that by taking 5 million times 7% times 6/12 or 1/2, right? Half a year. And they received cash of 5,400,000. So again, let's go with what we know. We know how much cash we're getting. 5,400,000. And then looks like they want us to do that on the bottom. We know we're going to have to pay back the amount of the issue. So $5 million. So which side are we going to have to put the money on to make this thing balance? The credit side, right? And then we know that's going to be 400,000. Right. So now I have 5,400,000 on the debit, 5,400,000 on the credit. That entry's on the credit side. This is going to be a premium. So because this bond has a favorable interest rate related to the market, we're getting extra cash for it when we issue it. Investors are willing to pay 5.4 million for $5 million worth of bonds. This is pretty awesome for me because I get 5.4 million, but I only have to pay interest on the $5 million face rate, and I only have to pay back 5 million at the end. Effectively, what that does is it reduces the cost of borrowing the money. My interest expense will be lower as I amortize this bond premium. All right. So remember, we learned a little bit about amortizing bond discounts yesterday. So today we'll learn about amortizing bond premiums. It's the same exact process. The idea is if we got paid extra, like on that last example, we got paid $400,000 extra for the bond. We don't want to just claim that as like some sort of a bond premium revenue right now. Instead, since the bond's going to last for 5 years, let's spread out that extra over the 5 years. So again, we take the amount of premium, just like we did with discount yesterday, and we divide it by the number of interest periods in the bond's life. So because the bonds pay semi-annual interest, a 5-year bond would have 10 interest periods in its life. It will pay interest 10 times in its life. So we would take like the 400,000, divide it by 10, and then we would recognize that $40,000 as part of the amortization process each time we pay interest. Okay. If you remember, when there was a discount, it increased the amount of interest we were paying. Our interest expense was higher than the amount of cash interest we had to pay because we also had to recognize that that part of that discount was part of the cost of borrowing the money. With a premium, it's actually going to reduce the amount of interest expense, which I'll show you right here. So there's just what it's going to always look like. So when we're amortizing a bond premium, you'll see a credit to the interest expense, which means reducing expense, okay? So usually the entry that we're going to make is going to look like this, where we debit interest expense, we debit premium on bonds payable, and then the cash is the amount we're going to pay out. So let's look at an example of it. So let's see. Here we have a premium on bond payable of $3,769. Term of the bond is 5 years, which means our semi-annual amortization is to take, there's 10 interest periods in the bond's life. So we'll take 3,769, divide it by 10, and that'll give us $376.90. So each time the bond pays interest, we're going to recognize the bond pays 6,000 in cash. We're amortizing $376.90 worth of premium. And so our actual interest expense then is less than the amount of cash we paid out. Why? Well, because we had a premium, because we got paid extra for the bonds, and the amount we got paid extra is reducing our overall interest expense of borrowing. Okay. That's what I just said. But if you're a reader and reading it will help you, read away. All right, let's look at an example, number 2 from the guided. All right, Smiley Corporation. Do you think it makes you happy to work there? I think so. All right. They repair products and equipment repair products to equipment manufacturers. They sell repair products. Gotcha. On April 1st, 2021, Smiley issued $20 million, 5-year 9% bonds at a market interest rate of 8%. So here we have a bond paying higher than the market rate. They received cash of $20,811,010. Interest is payable semi-annually on October 1st and October 1st. All right. So first, it wants us to journalize the entry to record the issuance of the bond. Again, when in doubt, start with what you know. It says they received cash of $20,811,010. So that's going to be my cash going up or being debited. It also tells you the amount of the bond. Here it is, a $20 million bond. So that's going to be my bonds payable on my credit, right? Because it's a liability I owe. So pretty quickly looking at that, I can see I need to credit this transaction 811,000 to make it balance. And that's going to be my premium. All the premium means is the amount over and above the bond amount, right? The amount that you're technically borrowing. That's the amount you got paid in addition to that. So there's our journal entry to record the issuance. Now it wants us to journalize the entry to record the first interest payment on October 1st. The amortization of bond premium for 6 months using a straight line method, blah, blah, blah. Okay, so whenever we pay interest, our cash will go down. We're paying something. Also, we're going to have an interest expense. And with a bond that has a premium, we'll be amortizing a portion of that premium. So we're just going to debit the premium on bonds payable. So to figure out the amount of cash we have to pay, we take the face value of the bond, $20 million, times the face rate of the bond, 9%, times time. And since it's for 6 months, that's half of a year, right? So principal, 20 million, times rate, times time, which is 1/2. So this bond is going to pay $900,000 in cash out to its bondholders each year. Since our premium on bond payable has a credit balance, then to amortize it, which means to reduce it down to 0 over the bond's lifetime, we're going to do a debit entry each time we amortize a portion of that premium. So how much? Well, it's a 5-year bond. So how many semi-annual interest periods in a 5-year bond? 10, right? All you do is multiply it by 2. Since it pays twice a year, if it's 5 years, then there's 10 payments. If it's a 20-year bond, it would have 40 payments. Okay. So I'm going to take 811,000, the total amount of my premium, divide that by 10, and see that I'm going to pay 81,101, not pay, but amortize that much of my premium every interest payment. 81. Is that what I said? Yeah. So the amount of interest expense then, again, if you're in doubt, just make this transaction balance. It's going to be the amount of cash paid minus any premium amortized. The idea is because we got extra cash when we issued the bonds, that extra cash goes on to reduce the expense or cost of borrowing the money. Why was the company able to issue the bonds for $20,811,010 rather than the face amount of $20 million? And it's because the market rate of interest is lower or less than the contract rate of interest. When market rates drop, bond prices go up. Check our work, make sure I'm not spewing falsehoods to you. I know I have a dishonest face. People look at me and like, that guy's a liar. But I wouldn't lie to you about accounting. I might lie to you about other stuff though, just in case you're wondering. All right. I said, not guaranteed. All right. So we've learned about issuing bonds at par, meaning at their face value, at a discount, meaning when you get less money than the face value, and at a premium, when you get more money than the face value. So now, what happens when we are going to redeem the bonds? Remember, all of these problems, if you think about it, are from the perspective of the company issuing the bond, which in other words means the company borrowing money. Okay, so some bonds have a feature that's called being callable. It's called being callable. You can call a bond, which means you can pay it off early. It's kind of like if I were to borrow some money to buy a car and then I came up with some extra money, I could pay that off early. Okay, so a callable bond just means that it can be paid off early. And so when we pay off a bond, kind of like when we were dealing with depreciation of assets and then we would like sell off an asset or whatever, we had to like bring the depreciation up to being current at the point of sale and then sell it. Similar, when we pay off a bond, we have to make sure any of the premium or discount that's been amortized is current up to the moment, and then we pay it off. Okay. We can have a gain or a loss on the redemption of a bond. So a gain is recorded if the price paid for redemption is below the bond's carrying amount. Carrying amount is a fancy way of saying the bond payable minus any um, minus any uh, well, plus any premium or minus any discount. So a loss is recorded if the price paid for redemption is above the carrying amount. Sounds harder than it is. When we see an example, won't be too bad. So here's our example. Assume that on June 30th, a corporation has the following bond issue. Face value of bonds are $100,000. The premium on bonds payable is $4,000. So the corporation redeems 1/4 of, or $25,000 worth of these bonds in the market for $24,000. Okay. So here's what our journal entry is going to look like. Again, what do we know? Well, if we're redeeming, that means we're paying off our bond. Okay. So our bonds payable is going to go down or be debited by 25,000. Also, we're going to take 1/4 of our premium. Remember, premiums will have and so we're going to debit that 1,000. Then we're going to put how much cash we had. And the difference will either be a gain or a loss on the bonds. Here, let's have another example of a corporation calls the remaining $75,000 of the outstanding bonds, and they do it for $79,500. In other words, in essence, what they do, in this case, it says there's a private investor who owns those last 75,000 in bonds. And it's like they say to them, hey, instead of carrying this bond out to term and paying you interest like we promised, we're willing to pay you $79,500 right now for your $75,000 in bond and have you paid off. That's what that means. Okay. So the bonds payable would go down by 75,000. The cash would go down by 79.5. The remainder of that premium goes away. And so the difference, again, here we did 78,000 in carrying value, paid 79.5, so here we had a loss of 1,500. So what I usually like to do on these is I know the bonds payable that's going away. I know the amount of cash they're paying. It always tells me that. And it always tells me the amount of premium or discount the bond has. So once I do those three, I can see that the loss or gain is just the difference. If it has to go on the debit side to make everything balance, it's going to be a loss on the redemption of the bonds because it's an expense and expenses are debited. If it has to go on the credit side to make it all balance, it's going to be a gain because it's a revenue and revenues are credited. So that's kind of how I approach these. So let's look at a couple of example problems and see if it makes a little more sense. So the Hoover Corp, wonder if they make vacuums. I wonder if they suck. You ever thought about that most things you don't want to suck, but if a vacuum doesn't suck, then it sucks? It's kind of strange, right? Its lack of suckiness is suckiness. All right. They wholesale music. Oh, that's dumb. They wholesale music equipment. They issued a $20 million, 20-year, 6% callable bond on March 1st, 2012 at the face amount. So they issued it at par, okay? With interest payable March 1st and September 1st. The fiscal year of the company is the calendar year. Journalize entries to record the following selected transactions. So March 1st, they want us to do the issuance of the bonds at their face amount. That's pretty easy. We're going to go, when we issue bonds, it's like we're borrowing money. So our cash will go up and our bonds payable will go up $20 million. Face value is nice and easy, right? Because you're debiting the cash and crediting the bonds payable. All right, on September 1st, they paid interest on the bonds. So this bond was a 6% bond. So our principal of 20 million times a rate of 6% times time of 1/2, because it's for a semi-annual interest payment, 1/2 of a year. Okay. So 20 million times 6%. That gives you a full year's amount, 1,200,000 a year, and times 1/2. So they're going to pay 600,000 in the bonds. So we're going to do interest expense and cash. Again, nice and easy when the bond is issued at face value. There's no premium or discount to worry about amortizing, right? All right. Here, they called the bond issue at 102. This is confusing. It says the rate provided in the bond indenture. That just means when they drew up the paperwork on the bond, they agreed at that time that they could call the bond or pay it off early if they did so at 102, meaning 102% of the face value of the bond. Okay. So what that means then is they're going to be paying off the bond payable, which is 20 million. And the amount of cash they have to do to pay it off is 102% of the face value. So I'll just take 20 million and multiply that by 1.02, 102%. If you prefer to use like the percent button and stuff, you can do that too. That's just how I do it. So in other words, they're going to pay $20,400,000 in cash to pay off this $20 million bond early. That was part of the agreement with the borrower. I mean, the lender, sorry. They're the borrower. All right. So where do I have to put the entry to make it balance? Debit. I'd be debiting $400,000. And would this be a gain or a loss on the redemption? Remember what I said? It's on the debit side, it's an expense, so that's a loss. If it's on the credit side, it's a revenue, and that's a gain. The other thing, you could just look at it and say, well, I had to pay $400,000 extra to pay this off, so that's a loss, right? I'm having to pay extra. Whatever it works to get that in your brain, each of us thinks a little differently. So this is going to be a loss on the redemption of bonds. In other words, it cost me an extra $400,000 to pay this off early. But if we're paying $1.2 million a year in interest, it was actually still worth it, right, to pay it off early. Well, this doesn't say what we don't know what the term of the bonds was. We'll check our work. It's all right because your teacher never makes mistakes except for every once in a while, which is kind of not what never means. All right. And then let's look at the next problem. The Mia Breen Corp, no idea what they make. Oh, wind energy driven engines. That sounds pretty cool. To finance its operations, Mia Breen issued $22 million, 20-year, 4% callable bonds on May 1st at their face amount, with an interest payable May 1st to November 1st. The fiscal year of the company is the calendar year. Journalize the entries to record the selected transactions. So this problem smells a lot like the last one. Yep, smells very similar, right? So again, to issue the bonds, pretty easy. We'll go, we got cash, and we created a liability called bonds payable for $22 million. Did I get enough zeros in there? I think I need one more. So there's our issuance. On November 1st, we paid a semi-annual interest payment. So it'll be interest expense and cash. Again, principal times the rate times the time, 22 million times my rate, 4%, times my time, which is 1/2, because it's a semi-annual payment, $440,000. So there's our interest payment. And now here they're calling the bond issue at 97, which is a rate provided in the bond indenture. So again, when they made the agreement, the people who lent them money recognized that they could pay it off at an amount less than the face value. Why would they agree to that? I don't know. Maybe because it was paying good interest relative to market interest rates, so they were willing to take that. So again, we know that our bonds payable is going to go away, so we have to debit the whole amount of the bonds payable, 22 million. And then we also know that a certain amount of cash will be paid. Well, how much? Well, 97% of the face value of the bond. So 22 million times 0.97, 21,340, 1,340,000. So again, I can just look at that and be like, all right, in order to make this balance, I'm going to have to what? What do I have to do to make this balance? Yeah. Credit it? Yeah. Right. I'm going to have to credit it. So that's going to be a gain. And again, we can just look at that and be like, I'm getting to pay off $22 million in bonds by only paying 21 million something. So definitely I'm making a gain, right? And then what's the amount of the gain? I think I heard somebody say we just subtract, it's the difference between the two, right? Again, we just make the journal entry balance, we're in good shape. So $660,000 is my gain. And you'll see these sort of, I think they'll call them like extraordinary gains or losses, which doesn't mean like that's extraordinary. It means it's extraordinary. It's outside of the norm. You'll see it on an income statement, not usually up in the regular revenues and expenses of the company, but they'll be like other, or sometimes it'll actually be called extraordinary revenues or expenses, right? Because that's an unusual revenue. you're not paying off bonds and making some money on the difference very often, or an unusual expense, you're not paying off bonds and losing money on the difference. Like that's only every once in a while, but that would happen. All right. I guess I should check my work. Okay. See, we're making it. We're doing good. Is everybody good on this one? Some of you have like, the Rock, like the Rock eyes where he does his eyebrow, like, hmm, which could either look tough if you're the Rock or it can look inquisitive if you're a normal person. Like, hmm, I don't know. I can't do it. All right. If you go with it, that helps people realize it's interrogative, not just trying to look hard. Of course, he looks hard. He's a rock. All right. Most rocks are hard, are they not? All right. All right. So let's see. All right. We have a ratio to learn about here. This is called the times interest earned ratio. And so we're going to use our income before income tax expense. And then we're going to add back in the, oh, sorry, not add back in, but our income before income tax expense plus interest expense. And we're going to divide that by interest expense. So it's weird, I know. What this gets used for is when you're a lender and you're trying to say, can this person really afford to borrow this money? You'll look at their times interest earned ratio. So it's a way we assess the risk of people that we might be lending money to. Um, like if people do not have, you'll see people that will like really leverage themselves up to the point where they're barely making their interest payments, and so like when the principal comes due, they're going to be in trouble. You don't want to lend more money to those people. But of course, those are the people out looking to borrow money because money's tight, right? It's a funny sort of thing of our finance system that like the people who need the money the most are the ones who can't get a loan, and the people who need the money the least are the ones who are most qualified to get loans. And then the rest of us are in the sweet spot, like where we're somewhere between those two extremes. Um, but think about your own money. You don't want to lend money to people who you think can't pay you back, right? And they're like, if I had enough money to do this, I wouldn't need to borrow money. So it's a tough thing. So let's look at one example. Again, remember that formula: income before income tax expense plus interest expense divided by interest expense. All right. So here we have Averil Products Inc. No idea what they do. It's probably really fun. Here's their income statement. We have their interest expenses. We have their income before income tax expenses. Determine their times interest earned ratio. So all we're going to do is take, like for 2019, 5544,000 plus 440,000 divided by 440,000. That's all. So I got 13.6. Here I'll do 4,400,000 plus 400,000 divided by 400,000. I got 12. So if you think about this, this is a measure of it's called our operating income, actually, is what it's called, relative to our interest expense. Okay. So the higher this number, the more operating income we have relative to income expense, which means we're in a better position to be able to pay our interest and make other payments that we need to. So always with these ratios, like the first question I ask is what's better, higher or lower? Because you have to figure that out. And the way I figure that out is by saying, well, what's in the numerator and what's in the denominator? So what's in the numerator is your operating income, and what's in the denominator is your interest expense. So would I want to see my operating income higher relative to my interest expense? Yes, I would. So is the change in the times earned ratio favorable or unfavorable? I'm going to say favorable. And I'm going to click it, and I'm going to have 100%, and we're going to be finished with class 10 minutes early. Although I never took roll, but I'll figure that out. Are we good for today? That's enough. All right, see you tomorrow. Be kind. You never know what someone's going through.